Yep.
All right, welcome back. Matt Davio, Miss Trade with Andrew Horowitz of thedisciplinedinvestor.com. You can also find Andrew if you're on Twitter, on the Twitter stream, at Andrew Horowitz. And Andrew, thanks for coming on. I appreciate it. I know you're a busy guy down there in southeast Florida. So
Right.
Thanks for coming on.
Yeah, well, only reason why I decided that, now we're in daylight savings time, so I don't have to worry about my golf game in the afternoon.
What kind of handicap do you carry? What kind of handicap do you carry?
My clubs.
Wow, we should have set that one up any better. Thank you.
Boom.
But
Yeah,
seriously,
thanks.
how much do you play? Do you get 5 rounds in?
I haven't.
20?
About, I'll hit in the 90s, and I'll be respectable every once in a while. Every once in a while something goes flying by somebody's head, but, aside from that, I love the game. I can hold my own, but unfortunately, I live across the street from a beautiful golf course. But, these days between the blogging, 3 podcasts, managing a chunk of money, and all the things in between, not to mention 2 kids in college, 1 kid and then, of course, my wife, and we can't leave out the dog, there's a lot on the table.
Well, let's start from the early days. Have you always lived in Florida? How long have you been in Florida?
I've been in Florida since '87. Moved down here from New York, and what happened? I looked and I said, everybody's moving down to Florida when they retire. What am I waiting for?
Right.
What am I going to wait till I'm 65 years old and then move down to Florida at that point? I mean, what's the point?
I agree.
So I decided to say, we'll check it out. I didn't have a lot of roots at the time. I was young, and I moved down here. And what was great about it was pretty much wide open back in '87. Back in '87, it was a whole different environment than it is now. I mean, it's not a New York here, it's not a London, but it's a lot more infrastructure built, a lot more business down here. So I moved down in '87 and kind of plunked down the stakes and just said, "Wow, this is."
Did you go to college back in New York or back east, or
up in New York?
Okay.
Up in New York, and came down here and immediately just started working in the financial business. Always been a student of the financial business.
Yep.
Actually, never finished college.
Okay.
I decided that what's the point of doing this when I can be making money in the markets? And I loved studying economics.
Right.
I loved studying everything from an early age. And really, just one of the things I did, just for your listeners, is that I absorbed everything that I could from the best that I was told in the industry.
Right.
That's how I learned everything that I could learn. I still do that. You find the best people in the industry, and you just basically just suck them dry as best as you can of their information, and
I
it's
find
great.
it interesting because I agree as a trader, and I didn't learn about trading in college, and I don't think many people do learn about trading in college. There's very few programs that even have real trading desks, and I think the only way that you learn about trading is by doing it. And it really comes down to any specialty, whether you're a doctor, lawyer, you really still have to go to school, but you still have to do it. You have to experience it. You have to live it. So you said at a very young age you were interested in the markets. How young? When when did that light bulb go on for you, Andrew? I mean, when you were 8 years old, and did you have a family member that was involved in markets that got you interested? What happened there?
Yeah, my grandfather was always talking about the markets, always talking about the Dow and, this stock and that stock, and I was always listening in to what he was talking about. Probably from around, when the light bulb went on that I could really remember identifying, I was probably 14, 15 years old.
Yeah.
And I remember maybe a little earlier than that. And I remembered, this is interesting. There's another way than just using your hands and using your money that you make from working of any sort. There's another way to actually make money. Now, that could be good or bad. I could do both, right? I could have a job and I could have an account of some sort, which my grandfather did. He was actually president of public corporations at the time. I just really spent time learning everything that I possibly could. At the same time, I'll tell you something. In the early days, I learned things that I realized I shouldn't have learned. You realize that when you're in the business and professionally doing it, that people are teaching you, and when you're young and impressionable, you listen to them.
Right.
But then when you step back, it takes a while sometimes to realize what's going on. You realize, man, that guy just ripped that guy off. That's not good.
Right.
So it was, good experience to learn how to not do that and both sides. So that because this business can, that it could really do a lot of damage to people who aren't aware of what's going on, particularly the client.
Absolutely. I agree. And that's part of, again, my reasoning for doing this series is to talk to people about, some pitfalls and some traps that, you need to be aware of. And obviously the environment is such now that people are more aware with the Madoffs and the Bear Stearns and the Lehman collapses. But it's always been out there. There's always been pitfalls, and there's always been sharks in this business. So as a child, again, so you're 14, 15. How about games? What types of games did you play? I'm always curious.
What kind of games did I play? That's a good question. I mean, I used to flip cards all the time. You know, we used to have the setup of cards and. Well, I played poker, love poker. Yeah, I love poker.
Yeah.
Played blackjack and those kind of cards, but I played flip cards, you know, the baseball cards.
Yeah.
And those had to be set up a certain way and understand. It was a bit of a, if you really think about it, it was kind of a behavioral finance process.
Right.
Because you had to know what the other person was doing in order to kind of flip your cards in the right order and then get them.
Top batting average takes the next card type thing, and you'd have a stack of 20 cards and you'd trade them among your friends. Yeah.
We would do it with colors. We would do the team colors. So you'd set it up, and whoever got a match the color, you'd get those. So you'd have to know, okay, this guy would do it this way all the time, set your cards up that way, and double down on certain things. Anyway, the point was that you had to kind of like have a good understanding of, I mean, this is kind of silly. It's not like, you know, brain surgery or anything, but it would be, it would make you understand all the players around you, how they were thinking, what they were thinking, and what you had to do to win theoretically, and know that they were thinking the same thing at least.
Right.
So you know, that was something.
That's a trade for sure. I mean, that's, as you said, behavioral finance. I mean, trading and charts and fundamentals and technicals are nothing more than somebody's got to take the other side of the trade. There's got to be a buyer and a seller for us to agree upon a price.
Exactly.
So you came up with a market that said, hey, if you match a color, you get that color. If you don't match it, it goes into a pile until you match, right? So
exactly.
That's very interesting. I've never heard that one. But so did you play baseball, football, those types of games when you were a kid?
Yeah, I played baseball, tennis. I didn't play much golf at a young age, but I played a lot of tennis. I played one tryout of football, and I decided not doing this. Too hot.
You said that's enough. Yeah.
Didn't get hit. It was just the running. I said, what's the point of the running? I'm not doing the running. You know? Yeah. So then played a lot of, like I said, played a lot of tennis. I was into boating, into fishing. We went out to Montauk every year when I was young, and big boaters. A lot of fishing out on for stripers and fluke and sharks and whatever else we can do out there. Really enjoyed that, and also big into photography when I was young. Actually had my own dark room. And then grew up and did the same thing and didn't need a darkroom anymore and still fish and have a boat, have a little house on a lake up in north part of Florida with some jet skis and have a good time up there.
Awesome. So, you know, there's a lot of themes there. I mean, fishing to me is not very, you know, it's a sport that demands a lot of patience, I believe.
Yes. Oh, yeah. No question.
And trading and investing, I think, no matter what your time frame is, demands a lot of patience. Would you agree with that?
Yeah, I mean, different kinds of patience, right? I mean, patience and frustration wrapped up in the same thing. That's also with fishing. You know, fishing, a lot of times you may get a fish, but it breaks off the line. Right? It may break off the line as soon as it comes right up to the surface. The fact is that, you know, in fishing also there may be days upon days that you're just out there and you're seemingly doing all the right things, but nothing's happening. And you're not winning, so to speak. So I think there's a lot of things there. And unfortunately, the same thing happens.
Yeah, just as investing and trading, you could put on a position and have it be the right position, but the wrong time and the wrong place.
Right. Or just do nothing forever. I mean, there's difference trading and investing. We also, I mean, you put a position on and you buy, you know, ABC stock and it just sits there and just sits there and just sits there for weeks at a time. And you're thinking, what's happening? Things are passing me by. So, yeah, no, it requires a lot of patience. And sometimes you have to listen. Sometimes you got to throw it in and say, okay, enough is enough. I'll come back another day.
Right.
But at the same time, you have to do what you believe is right and know the right, you know, the right bait, if you will, to put in the water in order to catch that fish. And if that doesn't work, you also have to know you're going to have to change it up. You know, you're using the red lure for 3 days because you know this is the right one, but they're only biting on blue. Well, you be stubborn and fight the fish tape, if you will. You know, you're not going to get anywhere.
So you moved down to Florida in '87. Is that when did you get into the financial industry at that point right away? 20 years ago?
I did. Yeah, I did. I was doing a bit in New York, but at the same time I decided that maybe I'll come down to Florida and continue it. And I hooked up with some great people. There was a few people on the radio down here that were doing a great service and had a radio show on the weekends, very popular. And I started working with them because they really understood at the time, you know, back when it was a different world back then, even 20-something years ago, you know, what was going on, and it was a great way for me to get clients. And I still have many of those clients from those days, as a matter of fact. And then became more involved. Those were the days of the mutual funds, primarily, packaged products, if you will.
Right.
And then became much more involved in individual equities, a lot more research on that level, and kind of broke away and did it on our own more so.
So how long have you run your own shop, your own registered investment advisory shop? How long have you done that?
I think it's since 1990.
1990. So pretty soon after. I mean, you were down there 3 or 4 years, and you got right into it. So,
right.
What do you think makes a successful money manager from your perspective? You've been doing it now for almost 2 decades, plus 2 decades. So,
I think,
and that says something to your success, because it is a difficult business, and it's difficult
right.
for a myriad of reasons. But even when you make customers happy, there's always somebody that's going to do better. Even when you
always.
Always. Even when you beat somebody, there's always going to be somebody doing less than you. So how do you manage that process, and how do you manage your clientele? Because some clients need to be fired when you're managing money, and I think that's probably an important process that you have to weed through. And hopefully you've got a stable of clients now that are with you because they like Andrew Horowitz, not because
right.
you're a good golfer.
Well, and not only that, if it's all based on performance, let's get back to that basic point, because a lot of people who may be watching, they think that, okay, I want a guy that's going to make me 100% a year or 200% a year or 30% a year or whatever the number is. And yeah, if you make 30, why didn't you make 40? If you made 40, why didn't you make 50? If you lost 2, why didn't you, everybody else lost only 1? I mean, it just, you can go that route, and that's the game that the mutual funds play, and that's why the current markets are doing what they're doing. Everybody's trying to play catch up right now, it seems, at least in the mutual fund business, with a lot of money. But I think that it really comes down to taking care of your client. I mean, not to be corny here, but it comes down to doing what they need and making sure that sometimes you not only answer the hard questions, but you bring the hard questions to them. There have been many clients, as I say, that sometimes you can take the client to the water and make them drink. Sometimes you have to take them by the hair and put them in the fountain. Okay. I fired a client this week, as a matter of fact, on Monday. And that's not a usual occurrence, and it so happens it's kind of unusual, but there's been a few. This client I've also fired. I thought about it just after I fired this client. I also fired his father once before in the field. So it's like a family thing, I think. He just became too difficult to deal with. There was too much requirement. He was doing things that were bad for him, frankly, and without going into the whole story, I just couldn't handle him as a client anymore. But the main thing is that why do you have clients for a long time? It's basically because, number one, you communicate with them, you provide them the information that they need. As opposed to a broker who's transactional oriented, we're really in the information business. We do our best as investment advisors to provide a solid rate of return over time. But in the beginning, we communicate that, we're not going to be the S&P 500. We don't want to be. That's not our game, okay? We may be up 10% one year when the S&P is down 5. We may be down 10 when the S&P is up 10. We may be right on all the time. That's not the game that we play. Our game is that we're going to make money where we think the risk is appropriate to do so in any condition. Really, our playing field, our stadium, if you will, and our tools that we use are those that work with stocks. They work with bonds. They work with mutual funds. They work with ETFs, whatever we're using, okay, options, whatever it is. But what we do is what's appropriate for the client in the environment that we believe. That doesn't mean we're always beating something, because we think that game is a loser's game. Last year, there were advisors that were all, giddy that they beat the S&P 500 by 10%. And I would say, so you only lost 28% and you're happy about that? Right. I mean, come on, there's something wrong with that whole model, but that's the model that
couldn't agree more. I think that's a big problem in the industry, is the whole bench game. Again, the benchmarking, again. Right. You can set a bench against anything. I'm going to beat the S&P minus 20 every year. Well, big deal. Right. Like you said, who cares?
Right.
So you're an absolute, you're an alpha money manager, meaning you're hoping to make money year in, year out. Obviously, you've been fairly successful doing this for 20 years. You talked about the key issue always, I think, for people, and that is risk. How do you go about, when a customer comes to you, how do you go about establishing parameters? Obviously, age, how much money they have, how much money they're making, all these things come into play. But risk is the most important thing, because you've got to preserve, I think, first and foremost, as a, as the keeper, the gatekeeper of your client's money. That's your job first and foremost. So how do you go about doing it?
Well, I say that risk is a 4-letter word. Let's say that first of all, okay? It's definitely something that is the dirty language, because there's ways actually that we think that we can contain risk. containing risk does not always mean that you're going to be successful at it, but risk mitigation is a big part of what we do. So we use things like, we may use options, for example. We haven't been really excited about the options this year with the VIX as wacky as it's been, although lately it's a little bit better. In the 20s, it's still very high, and option pricing based on volatility is really much higher than we want it to be to utilize like a long-term put, let's say, against a portfolio. Yeah. We find it to be a little bit expensive to do that right now.
Do you tend to buy options then?
Yeah, we'll buy options, but, we use covered calls for a long time. But I got to tell you something. After last year, before last year started to really get ugly, we pulled out of our covered call strategy because we said, you know what, we want liquidity. Yeah. And that's a big issue when it comes to the risk. And you know what, if we have covered calls, all of a sudden I start selling the underlying security. We got the naked call sitting there. That's not a game we want to play. Right. We can get really busted up. Now, obviously, it would have worked out fine because we would have made
it works in up
very limited strategy. Yep. So, either a flat or a little bit of up trading. But when the VIX is where it's at this point also, what we're finding is that we can't get, for a while, we haven't been able to get good premiums on a lot of positions, but yet the put premiums have been out of control.
Right.
So, we could sell puts to try to enter into a position. We can do that, as an uncovered, just a put, sold. And we could do that to possibly enter into position and hopefully if it moves down, we get that and we're saying, okay, well, if we get the position at that price, we're happy. But risk also, we try to do a lot of advanced economic work. Now, between economics, technicals, fundamentals, and quant, we use what's called a Quanta Fund technique. So quantitative analysis using screens, fundamentals, looking under the hood, looking at the various ratios and understanding balance sheet and cash flow statements. And then the technicals, understanding, when's the good buy point, what is the support, and, a variety of other indicators. The problem has been that a lot of stuff has been turned on its side lately. I mean, we can't even get a reasonable level of down move before all of a sudden there's money just being flushed in the market. That's a good thing. The liquidity trade is on. The risk trade is on. But the truth of the matter is that there's something a little bit lopsided with all the basic indicators when we're seeing earnings coming as they are and all that. So what we told the clients about today versus what we would have 10 years ago, because 10 years ago was a big discussion about asset allocation. We talked about diversification. We talked about all these different things. Diversification meant nothing in 2008. You could have been in the most diversified portfolio in the world, just incredibly diversified, true diversification, based on like mean variance optimization, all these great studies that were done by Brinson, Briebauer, and Hood in the years past. The fact of the matter is it didn't mean anything. Okay?
Well, I would actually argue with you that it's the same today. I think correlations are
I agree.
I think correlations are, so not argue, but I would say that, today we have the same problem. Everything is moving together to the upside, just as everything moved together to the downside. So you're absolutely right. I mean, all asset classes are rising, whether it's stocks, commodities, futures, currencies, everything, except for the dollar. Everything, and so that's the trade right now. The dollar goes down and everything else inflates. And as you said, that is the risk trade right now. So
and what's interesting, don't you find it interesting that the dollar really never had this kind of, there was no relationship like this ever before?
Never.
There was clearly if you overdid it on either direction, right, And let's also say to everybody listening, we never had currency swings like this before. 1% currency swing, you would go and hide in a closet for a 1% currency swing. And now it's like, oh, the dollar's up 1% against this one. I'm like, what?
Right.
It's a whole different environment right now.
And I think, Andrew, part of that is, again, because it is what I call intervention nation we have become. We don't let things flush out. Nothing does. Everything is either too big, too small, or too medium to fail. We don't allow these things to flush themselves out with the natural market occurrences. So we're almost moving towards a socialistic approach to our monetary and fiscal policy because jobs are related to whether it's car companies, whether it's insurance companies. So votes are attached to that, and we get into the spot where, again, nothing is happening. You've got a lot of zombies out there. You've got a lot of assets that aren't worth what they're saying. You can't short them because it's too dangerous because of this intervention that goes on. So you're kind of in this stalemate, and it is a really weird time. And that's one of my big problems right now is how do you define that risk? And so I'm curious, from a money management perspective, it's a lofty, difficult bag to carry right now.
It is. And I'll tell you something, just to go back on your zombie discussion, it may be for you as a trader, you could trade a Fannie, Freddie, or an AIG, but we look at it as like one question. Why are those stocks still trading?
Right.
I don't even understand. It doesn't make any. Who is allowing these stocks that are basically dead in the water to keep on trading, and for what purpose?
Well, it's again, it's simple. It's all the jobs that are associated with those companies, or the federal entities. That's all it is. I mean, General Motors. Why was it trading for as long as it did? It finally went bankrupt, and now they're back in business with $80 billion. That's not going to it's not going to save it. It's just going to.
But all I'm saying is they should have taken that off the market. There's no reason that they should be trading. You could keep the.
I could probably sit down here and pick 500 names that are like that. I could probably give you 500 banks that are like that tomorrow.
Right. So, exactly. So as a money manager, it's risk. So what do? One of the things we have to do is we have to watch our down. First of all, position sizing. It's really important with our active portfolios. Okay. Let me just back up and say something. We have different kinds of portfolios that we manage. And let's just break it up into two different components. One we'll say is our aggressive active strategy. We call that the disciplined investor managed growth strategy. We say it's like a hedge fund without being a hedge fund. Everybody has their own individual accounts, okay, $50,000 minimum, whereas traditionally on the other side is a $500,000 minimum. And in those accounts, we can trade rapid fire if we want. We can buy and hold. We can short. We can go long. We can use options. We do what we want in that account, okay? On the other side, we use our global allocations, primarily ETF organized and diversified. Okay. And what we do over there is we'll have Brazil, and we like the BRICS minus the R. Right. So we got Brazil, India, and China as an example. We'll use anybody that closes their market on any given day because things aren't going well, we don't like them so much. I mean, I can't deal with that, okay? And then on top of that, and it's also too related to oil. I mean, it's like directly related to oil and correlated there. So we'd rather have an oil play if we're going to do that, or some kind of other, energy play. And then we'll have some gold. We have silver in there. We have some material ETFs, et cetera. We'll go short if it's appropriate to go there. We'll have more cash. We have some core bonds in there as well. Okay, that's that side. Not as much trading over there, but we're not going to sit on that forever either. And we'll use sector allocations and more tactical allocation. On the other side, we're active, very active on a daily basis. We'll add to a position. So we start out, for example, risk management with a 1% position. May not seem like a lot, but that's what we call an initial position. And depending on our level of desire on how much we either like it or a commitment to that company or a conviction, we'll add to it. We'll double it. We'll go to 2. We'll go to 4. 5 is the max. So right now, 5, for example, is a Microsoft, is a Walmart, for example. 3% is Consol Energy. 2.5% has been Sears for a while. Now, the problem is with these markets, you can get taken out very quickly on any of these. We have stops that we use. You have to be careful, though. Because right now the game is all about the 50-day and the 20-day moving average. Right. And it's all about key support areas. It's uncanny how a stock will drop on an overnight earnings report or during the day right to that key support level, right, and then try to make it above its 50-day again. Right. Or you take a 10-week moving average, a simple 10-week, and find where it's going to kind of come back to a 10-week and kind of ride it for a little while. And it seems that if it does that for long enough, especially with an inclining 10-week moving average, it starts to pop off. Right. It's this game that's being played. What it is a professional hedge fund money manager game that they've used and almost to a point bastardized. They've gotten to a point that is ridiculous. Yeah. So what we're doing right now is you have to look at fundamentals, okay? But when you look at fundamentals, you have to understand one thing that's very important. It's like an amateur hour out there. Yeah. Last night, Fuji, a Chinese jewelry company that's been just on fire, a little thin trading sometimes, but lately it's been much better. It was up over 10% in the after hours due to their earnings report, and it dropped close to 20% right afterwards. Now, what's happening? It's all headline based. Yeah. It's all amateur headline based that you're just buying in because it came out and then they drop it right down. Almost every single day, if you watch that, look at what happened with Baidu. Right. Baidu dropped, 85 points? Now, whether or not that was real or not and should have been or shouldn't have been, who's dropping shares that much on a company, a liquid company like that? And then they drove it back up like 35 points the next day, just to kind of close it down 50. Right. Expensive company, but as a money manager, we have to be really careful about that. We have both short and long positions. So right now, we're short the small caps. We find the small caps are severely under pressure compared to the large cap. Even though the risk trade is on, it looks like, for example, to us, from all the things that we're looking at, that the small caps, if it gets hit, they're going to get hit hard. Right. Okay? Well, the last number of days, this has been very true.
You're seeing a lag. Small caps, I always say, I like to look at them Are they leading us? They definitely led us out of the February, March bottom, and now they're lagging. I don't know if they're going to make a new high or not. They're definitely not. So you've got the broader 2,000 Russell sitting there not making new highs. The Dow 30's made new highs. That's easy to move. S&P is right up to its high of the year. You got the end of the year piece. You have all these factors coming into play. You've got fund managers that last year didn't get paid. This year they're holding on, so they're going to get paid. They're not going to sell their position.
Right.
I don't think.
Right.
The government needs to, finish their first year strong. So, the Bears have no chance towards the end of this year unless, again, there's an event that comes out that the Black Swan event that could come out, but nobody's clearly expecting it.
Right.
So the whole boat, Andrew, is loaded long. You would agree, and has to play that game. So there's heavy risk. I always say whenever I can see very clearly everybody's cards and everybody's on the same trade, it's very risky. However, I don't think it's difficult to bet against right now, and I wouldn't necessarily be shorting right now either across the board. So
we have, for example, a 10% position of RWM, an ETF that is a short for the Russell 2000. We have a small position of S&P short,
right.
And dare I say we're short Caterpillar right now. But we'll move in and out very quickly. We're not going to hold it if it moves against us dramatically. For example, we were short, much shorter, much more neutral, much more lower position a few weeks ago where we shorted Win into the earnings, made about 12% real quickly, blew the position out, and now it probably went up about 10% from there, so that was good. Potash hits about 100 or so. We're going to probably end up about 101, 102. We're going to short it. We shorted it. I think we bought it back at 84 and covered it up.
Right.
AutoZone, I think we shorted at 148, picked it up at about 132 again. We're out of that. We're going to wait and see what happens with that. Fiserv, we were also short, made about 6% on that.
Yeah.
We made nothing. I think we lost a little bit of money on Wells Fargo. We think that Wells Fargo could be under a lot of pressure here because Buffett now needs all his money set aside to keep the rating companies who are about to go bankrupt, happy, particularly with this Burlington deal that he just put together, right? So the thing is that is he going to have the money to back Wells Fargo as much as he had recently? Yeah. And we think that if you look at the banks lately, Wells has been under a lot of pressure. I agree with you. It's a very tough thing to short. Totally agree. We were in SKF for a few days. We got burned by about 5.5%, 6% on a very small position. We take it out. Yeah. So the risk is we want to be in the best that we think the best, add to it as we go along.
Right.
It's okay that we don't just hit it with a 3% position right now. As it's moving in the direction we want, we'll go more. And then we'll start putting in some short hedges possibly on a broad-based market base. But again, you got to be careful with that because
you guys are liquid and you're playing the right game. I mean, you have to be. I mean, I think anymore, if I have a money, again, I don't want a money manager that's not going to be actively trying to drive alpha for me under managed, risk situations, which sounds to me like you've got a, fantastic grasp on. So, I think my whole, the whole point that I see with money managers is, hey, find somebody who actively has his or her money with your money. Find somebody who's seeking opportunities and is not, selling you this diversification plan over and over again. Because as you said, that's, you can be diversified to the hilt and not do well in a market like we were in and like a market we are in. And I think the market of the future is going to be more demanding for the individual investor. I think mutual funds are too big. I think hedge funds are too big. Be with the, you're in the right space. I mean, you're an active money manager, less than $250 million. That's controllable. That's manageable.
Right.
You start getting, unless you have a $1 billion fund with one client, it's very hard to manage big dollars because it's hard to put it on positions that are going to benefit the whole fund. So.
Right. And liquidity is a big part of what we do. I mean, I got to tell you something. The biggest thing right now is liquidity because I agree with you that is a black swan event going to happen? I mean, I don't know. CIT could have been a black swan event. It was a gigantic yawn event. That was a major issue, CIT. Right. The fact that we reached a 10.2% unemployment rate, while everybody wants to talk about this being a lagging indicator, here's where the problem is, that the stress tests that were done, were, that the banks are solid now. But that was only, if you look at that, we talked about that in this week's podcast. The fact of the matter is, and Calculated Risk did a great piece on this, where if you look at what the anticipated amount would be and the worst case scenario was, we're way off of that already.
Right.
So if you recall, one of the big issues was that under certain parameters, particularly about unemployment, the worst case scenario for unemployment, they would possibly require the banks to bring up more capital ratios.
Right.
The problem is that what I find really amazing is in about 5 months, 4 months really, the banks managed to fully capitalize themselves when we have increasing delinquencies, we have loans that are just in really bad shape, and I got to tell you something, one of two things. It's either the most magnificent business that has made more money, and I'm not sure what happened over those couple of years, it was a big mistake, or there's a major amount of BS going on here to kind of cover and to make everything look good because we haven't even started attacking the toxic assets. They've gone nowhere, the toxic assets.
Well, again,
they're just not there.
I live in Small Bend, Oregon, and I can tell you 3 public banks that are zombies. Absolute
Right.
zombies. I mean, you look at their books, and you'll see that they are zombie banks. And I know in Florida you've probably got 100 of them.
Oh.
100 of them within
Yep.
a 20-mile radius of where you are.
Right.
In Southeast.
Right. You remember watching the show? You remember watching the show Soap?
Yeah.
Remember Soap?
Yeah.
Okay. So remember when we'd have that guy and he would go and he'd be invisible?
Exactly.
Okay. Right.
Yeah.
That's it. Toxic assets.
Right.
Not there anymore. Right.
It's the 999 account. It's the massive 999
Right.
account. It scares me. And,
Right.
and honestly, as a trader, I don't want to do much more than trading right now. And I'm similar to you. I'm not a day trader, but I will I will day trade if the volatility is there. But if it's not, I'm in there 2 to 6 weeks types of trades anyways most of the time. So,
Right.
But it's a scary time because I would say I've been doing this 20 plus years also. And I've always had a pretty good inkling. Hey, we're going to go up. The cycle's now to the upside. Well, I don't know if we've necessarily seen a bottom. Who knows? I'm not even going to go there if we've seen the lowest prices.
Right.
I don't know if we've seen the
Right.
highest prices. But I can tell you, I do believe that there's going to be more opportunities for the active investor. And by active, I mean, again, 2 to 6 weeks over the next generation.
Right. No, I agree. It has to be.
That's about the only trend that I see. So aligning yourselves with the Andrew Horowitzes of the world, the mistrades, people who can educate you and explain to you some of these things that you won't ever see on CNBC. And again, I think that's a key point here. I mean, these guys are out there selling their book of business, yet are they involved in the positions themselves? Most likely not. They're just spouting off something that everybody.
Well, I'll tell you a story I wrote about. Let me tell you a story I wrote about recently. Mario Gabelli, I respect him, good guy, major player, and obviously nothing to be said about his past and all. But he was on the program on CNBC recently, and he started talking about a stock that he owns, a little company called Hawk. I think it's HWK, I think it is, the symbol.
Petrohawk.
Is it HWK? Is it? Yeah. I don't know if it's Petrohawk. No, it was Hawk Industries.
Okay.
I think it was Now, it was a very small company, admittedly. He talked about that. No float. They own like 12% of the company. And he started talking about how this company is going to double in a year, blah, blah, blah. It was up like 15% after he mentioned that. Now, that may not be a big deal to him in the big scheme of things, but I thought, wow, this is a guy talking on CNBC, which admittedly is one of the most popular of the business channels, whether we love it or hate it. It is, okay? And at the same time, this guy, a major player in the morning show, was talking about this small, tiny micro-cap company with no float and all that, and it's flying.
Yeah.
And I said, I cannot believe that he actually said that. Now, subsequently, it came down. It probably been a great stock to short. But the point of the matter is, you don't want to get involved in something like that. Who knows if he goes on Bloomberg next? Yeah. Who knows if he goes on a radio show next and he's kind of doing this dog and pony show on this one stock.
Right.
But I'll mention something else to you. One of the things that we think is important, and what I don't want to say that makes us different, but it does, but is that our clients have access to a private blog. So when we manage your money, so let's say you give me money to manage, right? And we're doing our thing. Well, at the end of the month, usually you see all the trades, you see what happens, you see what you're holding. Maybe you can look online to see what's going on. But why? What's the reason that we bought, Cognizant Technology? What's the reason that we bought, A, B, or C, whatever it is, okay? And so what we do is we have a blog a private blog, you see some of our stuff on the Disciplined Investor, but our private blog talks about on a daily basis, we go in and say, okay, we bought an initial position of Rackspace today as an example, okay, Rackspace Holdings, RAX, okay? Don't buy anything I'm saying. There are not tips going on here. Let's get that straight, okay?
Right.
But, Rackspace Holdings, which we bought an initial position of after we liked the earnings, we've been watching them for a while, we like the technicals, so we put a position on that as an example today. And we talk to our clients. Here's a chart. Here's why. Here's some of the fundamentals. This is why we're buying this. And then let's fast forward. Let's say in 3 weeks from now, for whatever reason, Rackspace falls 7%, 8%. That was our stop point, or maybe it was our additional add to point, whatever it was. We'll say, hey, you know what? We screwed up. It's down. We're moving out of it. If we see the trend start moving, we still like the fundamentals. Obviously, market's not agreeing with us right now. Right. We'll move back into this possibly. Right. Or as an example, when we see things, we use a Bloomberg system. We have the Bloomberg terminals, and we've created our own charts for all the economic indicators that you can imagine that goes back 20, 30 years, and we show trends over time. So a lot of times when you see on the Disciplined Investor those charts on there on the eco, that's the charts we develop here because we're studying those all the time. Right. And we take those and we put those on the private blog at Horowitz & Company, at that private blog for that site. So at the end of the week, everybody can see all the separate articles we're writing because we link all of those, right. Plus a summary of all the things that we've done all week so everybody feels that they're in the loop. Plus we have commenting. So people comment and say, hey, I don't understand why you bought ABC stock. It's a piece of crap. What are you doing? Well, yeah, it may be a piece of crap. We're doing it for a trade. We think there's a great trade opportunity here. We think the fundamentals are crap. We think all this, but you know what? There's definitely a momentum move here on the stock. We're going to buy that, look for an 8% hit and move out. Or, or whatever.
So you lay out your story and you let your investors know, take it or leave it. This is why we're doing it, and we're putting on the trade, right. As you said. And there's nothing wrong with the trade. I mean, I think that is fantastic that you say, hey, yes, we think the economy is in the dumper, but it's just a momentum trade. It's going up. We're here to make you money. That's all it is. If it gets here, we're out. So you're laying out the scenarios, which is the most important thing. I think liquidity, risk, they're all interwoven. If you take care of those two, you'll take care of your customers. So, I think it's a great strategy. So again,
we try.
Andrew, we can find you on thedisciplinedinvestor.com.
Yep.
On Twitter, we can follow you at Andrew Horowitz. And
Andrew Horowitz. And then also I'll tell you just a couple of quick things. So we were nominated for a podcast award on all three of my podcasts. Okay. The Winning Investor, which is a very basic 5-minute per week. What's a PE ratio? What's a bond, call option on, or whatever. There's the Disciplined Investor where we have, you've heard it, we've had unbelievable guests. We get rated guests all over the place. And we're probably going to have, we're looking at, again, Zero Hedge for next week. Good. So if you're familiar with Zero Hedge, Tyler. Yes. Is going to be on, I think, a good friend, and a few other people. I mean, you know all the names. Robert Reich has been on, all that. So the Disciplined Investor is released on a weekly basis. Then I do a podcast with John C. Dvorak, a lot of technology discussion, open mic kind of thing, called DH Unplugged. So I'll ask your people to go starting November 13th to vote for us because now the nominations are in. Okay. So you can find that information on our site, and we post a lot of information. We posted a great story on Steve Wynn and how he created himself a fortune and saved a lot of taxes by his special dividend that he put out. I don't know if you saw the story.
I read that, and it was brilliant reading what you had written. It's he's saving, he's going to get taxed 15% on this special dividend himself, owns 48 million shares. What a windfall.
Gotta love it, huh?
Yeah, it's
gotta love it.
Yeah,
and Shelley Adelson is next. I'm sure with a $3.5 billion IPO on his McCall property. I mean, talk about, this is what I say. I've been saying this a lot. When you're fishing, back to my fishing, okay? If you go fishing and you're out for dolphin and they're eating, they're biting, right? You could sometimes throw an empty hook. We call it a baitless hook in the water. What do? They bite it anyway, right? Unfortunately, there's a lot of investors right now that are biting on baitless hooks. Yeah. They're not reading the information. They're looking at headlines. And I got to tell you something. The headlines these days, Bloomberg, CNBC, are all positive. I read a headline recently that said something to the effect of, German investor confidence higher. And then you look at the rest of it. If you went further in, it's higher, but much lower than expectations, and blah blah blah, or whatever it was.
Yeah, higher than
they left it off.
Being flushed down the toilet bowl. Yeah.
Right. They left off certain parts of it, and they make it look like, well, the earnings are better. Yep. Earnings came in higher, but yet when you look at them, higher than what? Higher than last quarter, but last quarter they had no earnings. Right. So what does that mean? So we're in a click and headline driven market right now that everybody clicks first, buys first, and then asks questions later, and then wonders what the hell happened with that trade. Yeah. So I think we need to be very careful right now.
So again, 2009 from March on has been easy. It's been a one-way train, all assets, all together.
One way.
2010, find your pros like Andrew Horowitz, because it's going to be a different year. I think you're not going to have everything. Hopefully, as a trader, I don't want everything correlated one-to-one. It makes it more difficult to find opportunities. So
yeah, you know what I'll do for you? We have a 14-minute virtual tour on how we do our strategy. And I'll give you that link. You can put it on your site, and people can just kind of check out what we do. I walk everybody through what we do, why we do it, and how we do it.
Perfect. We'll put that up on the blog post when we send the interview up. Thanks, Andrew.
Great,
Appreciate
Matt.
your time.
You're awesome. Keep up the great work. You're great. You're awesome.
Hey, thanks, man.